right, so I want to go over a little bit of terminology. We went over some terminology in the last video, talking about the asset classes and stuff like that. But this time, I'm sure you've heard stuff about people. I only invest in growth stocks or value stocks and income stocks. So I want to kind of go over the difference between them and why you would invest in each one, right? Because investors who buy stocks, you're typically going to do it for one or two reasons. Either you're going to believe that the price is going to rise and it's going to allow you to sell them at a profit, or you intend to collect dividends paid on the stock as investment income. Now, of course, some stocks can satisfy both objectives, at least to some extent. But most stocks can be classified into one of three categories, right? The growth, income, or value. Now, those who understand the characteristics of each type of stock, they can use this knowledge to grow their portfolio very efficiently, at least more efficiently than someone who really doesn't understand that much of the difference, right? And that's kind of why we're going to go over this. So I want to start off by talking about growth stocks. So, as the name implies, growth companies by definition are going to be those that have substantial potential for growth in the foreseeable future. Now, growth companies may currently be growing at a faster rate than the overall markets, and they often devote most of their current revenue toward further expansion. Every sector of the market has growth companies, but they are more prevalent in, certain areas. Think technology, alternative energy, and then biotechnology. Now, most growth stocks tend to be newer companies with innovative products that are expected to make a big impact on the market in the future, but there are exceptions. Some growth companies are simply very well run entities with good business models that have capitalized on the demand for their products. Growth stocks can provide substantial returns on capital, but many of them are smaller, less stable companies that may also experience severe price declines. So, what would be an example of this? Well, Amazon, right? Now, this company is a juggernaut and it continues to add features, open new markets, and take customers from other retail oriented customers. As of October of 2021, the trailing PE of Amazon, is a 58, reflected, this astounding growth potential compared to the S&P 500 trailing PE of about 27. So it's a big difference. So then let's talk about value stocks. So value stocks are going to be undervalued companies, and they can often provide long-term profits for those who do their homework. So a value stock trades at a price below where it appears it should be based on its financial status and technical trading indicators. Now, it may have high dividend payout ratios or low financial ratios, such as something that's called price to book or even price earnings ratios. Now, the stock price may also have dropped due to public perception regarding factors that have little to do with a company's current operations. Uh, as an example, the stock price of a well run, financially sound company may drop substantially for a short time, but if the company CEO becomes embroiled in a serious personal scandal, right, and it's not looking good. But smart investors know that this may be a good time to buy the stock, as there's a chance that the public will eventually forget about the incident and the price will possibly just revert to its previous level. Of course, the definition of what exactly is a good value for a given stock is subjective, and it varies according to each person's investing philosophy and their point of view. Value stocks are typically considered to carry less risk than growth stocks because they're usually those of larger, more established companies. However, their prices do not always return to their previous higher levels as expected. So then the third and last one to talk about is going to be income stocks. Now, investors look to income stocks to bolster their fixed income portfolios with dividend yields that typically exceed those of guaranteed instruments such as treasury securities or CDs. Now, there are two main types of income stocks. Utility stocks are common stocks that have historically remained fairly stable in price, but usually pay competitive dividends. Preferred stocks are hybrid securities that behave more like bonds and stocks. They often have a call or put feature or other characteristic, but also pay competitive yields. Although some, income stocks can be an attractive alternative for investors unwilling to risk their potential, their values can decline when interest rates rise. So let's take a look at a good example of an income stock. So the example that we're going to go over is going to be AT&T, right? Ticker symbol T. So the company is, it's financially sound, right? It's a very big company, right? It carries a reasonable amount of debt. It pays an annual dividend yield of about a little over 8%. Um, it might have gone up or down, but that was as of October of 2021, right? So it's just, it's pretty good. But how do you find stocks in any of these categories, though, right? There's no right way to discover specific types of stocks. Those who want growth can pursue investing websites or bulletin boards for lists of growth companies, then do their own homework on them. Many analysts also publish blogs and newsletters that tout stocks in each of the three categories. Investors looking for income can calculate the dividend yields on common and preferred offerings and then evaluate the amount of risk in the security. There are also stock screening programs available that, investors can use to search for stocks according to, very specific criteria, such as dividend yields or financial ratios. So, with all this said and done, what's the bottom line? Like, what do we do? What does this information help us with? Okay, just think stocks can provide a return on capital from future growth, current undervaluation, or dividend income. Many stocks, like AT&T that we just talked about, offer some combination of these. And smart investors know that dividends can make a substantial difference in the total return they receive. Right? So, you've got people like me who I try to invest in companies that are growth companies that pay a dividend, right? Because I don't need very large growth in a very short amount of time. I'm okay with a company, taking, maybe 5-6 years to go up 50-60%, or 10 years to go up 50-60% if it's paying a decent dividend. So, it really comes down to, again, what do you want? Because what's right for you, what's right for me, that might be different. So always do your research and invest in how you need to invest for your goals. But I really hope you guys enjoyed this video. If you're not subscribed to the channel, I'd appreciate it if you did. If you liked the video, give it a thumbs up. But until I see you guys in the next one, y'all be safe.